All right, welcome to this explainer. Today, we're going to look at bookkeepers a little differently. We're not just treating them as everyday number crunchers, no. Today, they are financial detectives. And their main mission? Making absolutely sure that a business's records are mathematically spot on. You see, every single transaction leaves a fingerprint behind. And in this explainer, we're going to learn exactly how to trace them.
But before we really start digging into the ledgers, I want to pose a question. Just kind of keep this in the back of your mind as we go. If your debits equal your credits, does that automatically mean your books are completely 100% error-free? Well, it's actually a super common bookkeeping myth that perfect balance equals perfect accuracy. We're going to completely challenge that assumption today. And trust me, there's a really fascinating twist waiting for us a bit later on.
Okay, let's dive into this. Here is our roadmap for the investigation today. Number 1, the bookkeeping detective. 2, building the trial balance. 3, the closing inventory mystery. 4, catching arithmetical errors. And finally, number 5, 6 invisible accounting errors.
Let's kick things off with Section 1, the bookkeeping detective, verifying the numbers.
So, as we start investigating a business's finances, we have to keep the golden rule of double-entry bookkeeping in mind, right? Every single ledger entry needs a matching debit and a matching credit. Because of this dual nature, verifying these records isn't just, a nice-to-have, it's absolutely essential for the structural integrity of the whole business. And that brings us to our main investigative tool, the trial balance. Basically, it's a statement that lists out account names and their balances recorded in debit and credit columns on a very specific day. But here's the crucial thing to understand. The trial balance actually isn't part of the double-entry system itself. Nope, it's simply a method of verifying the records at a specific snapshot in time. Think of it like a detective gathering all the suspects in one room just to see if their stories line up.
Moving right along to Section 2, building the trial balance. The rules of the game.
Now that we know what our tool is, we absolutely have to know the rules for setting it up. If we put the numbers in the wrong columns, well, our whole investigation fails before it even starts. And this brilliantly illustrates exactly how we organize the board. As a hard and fast rule, assets and expenses live exclusively on the debit side. That's the left column. On the flip side, contrasting heavily with that, we have liabilities, capital, and income. Those belong on the credit side, the right column. So if you buy machinery or pay your employees' wages, you debit. If you take out a bank loan, inject capital, or make a sale, you credit. Honestly, just keeping this visual hierarchy in your head is the secret to a flawless trial balance.
Let's actually ground these abstract rules with a real-world example from our source material. Take a look at this corrected trial balance for a business owner named Gorov. Notice how perfectly his assets and expenses are lined up in the debit column. We've got cash at $70, property and buildings at $70,000. Then, over in the credit column, there's his capital at $80,000 and sales at $760. When we tally the whole thing up, both columns total exactly $83,010. The columns match perfectly. The arithmetic holds up. Our detective work here is a total success.
All right, Section 3, the closing inventory mystery. The odd one out.
When you're building a trial balance, practically every account balance makes its way onto the board. But there is one very specific quirk, one prominent suspect that we purposely leave off the list. Let's define the suspect first. Closing inventory is the value of inventory that has remained unsold at the end of the financial year. Basically, these are the finished goods sitting in the back of the warehouse, stuff you bought to resell, but right now it's just gathering dust, waiting for a buyer.
So why on earth is this totally absent from our trial balance? Well, it's excluded to avoid double counting. Just think about the logic for a second. All the goods a business bought during the year. They are already recorded in the purchases account, which is sitting there happily in our debit column. Because we've already accounted for those purchases, if we were to slap the closing inventory value onto the trial balance too, we'd literally be counting those exact same unsold goods twice. It would double the effect and completely wreck our balance.
Which brings us to Section 4, catching arithmetical errors. When the columns don't match.
Okay, so we've seen Gorov's perfect $83,010 balance. But what happens when the math refuses to cooperate? Like, what do you do when the left column says 50,000 and the right column says 52,000? This is where we shift into active investigation mode. When the trial balance fails, it's usually because it caught one of these common arithmetical suspects. First, it could just be a simple addition or subtraction error in the ledger itself. Or maybe someone used mismatched figures, like, writing $100 on the debit side, but, oops, accidentally writing $10 on the credit side. Another big culprit is entering only one half of a transaction. You totally forget the credit. And lastly, entering a transaction twice on the same side, like recording 2 debits instead of a debit and a credit. Let's move to and see how this builds a really precise troubleshooting hierarchy for tracking down these pesky errors. If you've got a mismatch, just follow these steps. First, recalculate and check the closing balances of your ledger accounts. Second, verify that those balances actually made it to the correct trial balance column. Remember, assets to the left, liabilities to the right. And third, okay, here's a fantastic little detective trick. Find the difference between your totals and divide it by 2. If that result matches a specific transaction amount you've made, there's a huge chance you wrote that entry on the wrong side of the trial balance, which effectively doubled your error.
Section 5. 6 invisible accounting errors. The twist: they balance, but they're wrong.
And this is the climax of our detective narrative. Remember that hook question I asked you at the very beginning? Can a perfectly balanced ledger still contain errors? The answer is a massive, resounding yes. A perfectly balanced trial balance, even a beautiful one like Gaurav's, might actually be hiding 6 sneaky, invisible errors. The first one is an error of omission. This is exactly what it sounds like. A transaction is just completely omitted from the books. Imagine you sell $300 worth of goods to a customer named Jimmy, but you just straight up forget to record it. No debit, no credit. Because both sides are missing equally, the trial balance remains blissfully unaware and perfectly balanced.
Next up, we have errors of commission. This happens when you enter the correct amount for both the debit and the credit, but one entry goes into the wrong account of the same class. So for example, let's say you make a $36 credit sale to M. White, but you accidentally debit the account of S. White. Both are personal accounts, right? So the math works perfectly, the debits equal the credits, but the actual person being charged is completely wrong.
Now, what's really interesting here is the error of principle. This is when the correct amount is entered, but it goes into an account belonging to a completely different class. Imagine you pay for repairs to a delivery van. That's an expense. But what if you mistakenly debit the motor vehicle asset account instead? The columns will still balance perfectly. But by hiding an everyday expense inside a long-term asset, you have fundamentally skewed the actual financial reality and profitability of the business.
The fourth one is the compensating error. Honestly, this one is just wild. It's a pure coincidence where 2 or more completely random errors just happen to cancel each other out. For instance, imagine your sales account is accidentally overcast, meaning it was added up to be too high by exactly $30. And then, by pure dumb chance, your purchases account is also overcast by exactly $30. Because both the debit side and the credit side are artificially inflated by the exact same amount, the trial balance just gives you a false thumbs up.
Number 5. Errors of original entry. This occurs when an incorrect figure is used right from the start for both the debit and the credit. It's a simple typo at the source. If you're looking at an invoice for $130, but your finger slips on the keyboard and you enter $230 as both the debit and the credit, well, the trial balance will dutifully balance that incorrect $230. It literally has no way of knowing the real invoice was for $100 less.
Finally, we have the error of complete reversal. Again, exactly what it sounds like. The right amounts are used, but the double entries are made on the totally wrong sides. Let's say a customer, Mason, pays us $350 by check. We're supposed to debit our bank to show the money coming in and credit Mason. Instead, we mistakenly debit Mason and credit the bank. We have perfectly reversed reality. It looks like money is leaving our bank to pay Mason. But because a debit and a credit of $350 were technically made, the arithmetic stays perfectly intact.
So what's the big takeaway here? The crucial point is that mathematical balance does not guarantee financial truth. The trial balance is an amazing, powerful tool, but a truly great financial detective always has to look a little deeper. I want to leave you with this provocative question drawn right from our source text to chew on. Can the balance in the cash account actually be a credit balance? Normally, cash is an asset sitting happily on the debit side, but what if you withdraw more than you actually have? Think about bank overdrafts as you ponder the limitations of what a perfectly balanced column of numbers really tells you. Keep investigating, keep questioning, and I'll catch you in the next explainer.